Back to this channel. By the way, before we start, let me get something clear. Today's section, this very video clip you're about to watch, can be likened to a quick start course or a bootcamp learning mode with fundamentals that can give you immediate result if you're totally ready to be committed in mastering and studying it. I use the word study and not watch. That means I want you to go over it more than one time, like 2, 3, 4, 5 times, or as many times as possible, to fully grasp the details I shared in here for you to stick to your memory. Yeah, it will give immediate result because the information I'm passing here is concise and simplified, from basics to advanced, and filter out of unnecessary informations. I employ the use of schematic diagrams throughout the video because I really want to demystify details and make complex idea that always looks confusing when it comes to technical analysis very simple to each and everyone, even as a total beginner. This saved me time in the course of making the video, and I believe it will help improve memory retention as you watch as well, because the explanations are backed with diagrams that illustrate how different component phases, stages, ideas are connected in this entry criteria I'm about to share in this video. If you're a total beginner, do not worry, I got you covered, because these memorable schematic visuals will help you in getting clarity with ease about how to approach the market to make informed decisions to make money consistently, even as a total beginner without any trading knowledge before. And if you're already trading before now and you're not confident about your trading strategy or entry criteria, you want some little modifications or adjustment, stay with me. Just be patient and follow me closely with key attention. Do not fast forward any part of this clip. They are all connected from basic to advanced. What I mean is that you must understand the basic aspect in details before you can apply this entry method appropriately. And peradventure, probably you are watching as an advanced trader and got to some extent and think maybe this is not as advanced to what I've already learned somewhere else. Believe you me, whatever strategy you are currently trading with, be it SMC, ICT, structural liquidity, alchemy, trend line, break retraced, name it. What I'm about to share here do more magic than all those strategies I've mentioned, because I've been there, I've traded most of those strategies a couple of years back and know substantial details how to apply them in the market, but they can be compared to what I'm about to share with you now. So follow me closely. Mind you, I'm not saying those strategies are not working. Of course they are working, but most times they are full of confusing infos, and the commitment required to filter them out as a beginner trader before becoming a pro is always hard to so many. It may take months or even years to master before getting clarity. But with this quick start module you're about to watch now, if you study diligently as advised and apply it correctly, you'll begin to see substantial results in a couple of weeks that follows from the day you start studying. And I think this is one of the most important reasons why I took it upon myself to come up with this simplified approach that every individual can use to make money consistently in all financial markets. It does not matter which market you are in, currencies, crypto, indices, stock, or CFDs and options, right? You can use this approach to make money there. And the good news is that it is a pro-trend continuation entry method. As the popular saying goes, trend is your friend. Follow it and do not go against it. In case you don't know what I mean by pro-trend continuation entry, pro-trend continuation entry is an entry type that gives you opportunity to always take trade in the direction of an existing trend after a temporary pullback or consolidation. So we professional traders favor this approach because it aligns with the market prevailing momentum, and the advantages is it gives you high probability of success, align with institutional order flow, always give room for better RR, that's risk to reward ratio, and one can easily catch expansion move with ease. It reduces emotional trading, and if you're a day trader, it gives you daily clearer setup to execute on daily basis. I think I've said enough. Yeah. All right. This is what I wanted to get clear before we start. If you're a new trader or advanced trader that need modification on your current entry criteria, stay with me. Do not go anywhere and do not fast forward any part of this clip. So let's dive into the business of the day. On your screen, we can see the section we have today is in two parts, part 1 and part 2. So we're going to discuss part 1 first before we proceed to part 2. And part 1 will be, I will just discuss it briefly. I will discuss part 1 briefly because the main reason why this video is created is because of part 2. All right. So part 1, the very first aspect there is what candlestick composition, component composition and structure with regards to open low, high close, and open high, low close. That's part one. Then we discuss market structure briefly, price narration, storyline, phase, and objective. All right, 2 and 3 up. I actually have a complete video on 2 and 3. I posted that video on YouTube for over a year ago. So I will just discuss them here briefly. I will discuss them that you understand. But if you want to go deeper to understand the market structure and price narration, I will advise you to go back to that video so they can pay key attention to what I discussed there for you to understand structure properly. But I will do a brief explanation here so that you can understand what I'm saying. All right, let's proceed. Let's go to candlestick components, composition, and structure. Candlestick composition, components, and structure. All right, this is candlestick, right? So if you're an advanced trader, follow me closely. I do this because of people that are new to trading, and even you as an advanced trader, you have something to learn here, because this basics is key in this entry criteria. If you don't understand these basics, you will a kind of fall out in some areas when you wanted to apply this particular entry or this strategy. So follow me closely. Let me explain it. Even though you know it before, at least you have something to add. All right, this is candle A, and the first thing we're discussing is components. So this is a candlestick, and we can see it. What are the components of a candlestick? First of all, it has how many components? 6 components. It has a body, the opening price, the closing price, high, low, and the wick, upper wick, lower wick. This is a bullish candle, and we assume this is a 4-hour candle. It's a schematic diagram, but we assume it is a 4-hour candle. So in this 4-hour candle, there are 6 components. Low, high, open price, closing price, body. The distance between the opening price and the closing price is what we refer to as the body. Then we have the lower wick and the upper wick. Let me explain to you of these components. Opening price is the level where price open within this 4-hour window. Let's say this candle open exactly 9 a.m. in the morning. So it's open here by 9 a.m. It is a 4-hour time frame. That means when it is closing, it closes by 1. 9 to 10, 10 to 11, 11 to 12, 12 to 1. It closes by 1. It opens here, it closes here. Right? Now, I said the distance between the open and closing is what we refer to as the body. The low. This tells us that this is the level price reached in this 4-hour window before it pushes up. That means it's open from here, give us a low first, right? Open, it give us a low, then pushes up, give us a high, right? Retraces back and close. We see the structure now. We see the structure. Open, low, high, close. This is the structure of the candle. Let me move it out if I can be able to move it out. So this is the structure of the candle. Open, low, high, close. All right. So the wick tells us a story that price, first of all, as it opened, price first of all comes down first before it pushes up. And when it pushes up to this high, it did not close there. It also retraces back to this level before it closed. So the wick is telling us a story that okay, within this 4-hour window, price actually comes to this level before it go back to its opening price and pushes up, and it actually comes to this high before it retraces back to the closing level and close there. So the upper wick tells us where it reached, the highest level it reached before it retraces, that is the high. Then this skeletal part that you are seeing tells us the movement. The movement, the as it opens, as it drops down first. This wick is telling you okay, price come here first before it goes up, and this upper wick is telling you okay, price actually pushes up here, reach here before it drop down. So that's why that part is skeletal. It's in form of the skeletal part. The opening price, the closing price, that distance give us what we refer to as the body. So these are the 6 components: low, high, open, close, and the wick. That is 5. Then the body is 6. This is 6 components of a candle, and this is a bullish candle. For a bearish candle, it will be the opposite. And the representation will be what? Red. A bullish candle representation is green. A bearish candle representation is what? Red. But there is a key difference between a bullish candle and a bearish candle. And what is that key difference? The key difference is that a bullish candle open from beneath, it pushes down before moving up because it is going up. In the case of a bearish candle, it will open from above. It will open from above. So in the case of a bearish candle, we will have open, high, low, close. That is the structure of a bearish candle. And the representation will be red, just the way we see it here. We can see bearish candles. Open, high, low, close. See it. It open here, high, low, close. I believe you can see what I'm trying to do here. Open, high, low, close. So this is the what? The difference. That is the only difference. The representation is just green for bullish and red for bearish. But the opening price of a red candle is from above because it pushes down. The bullish pushes up, so the opening price is below. The bearish pushes down, the opening price is above. Get that clear? All right, let's see how this 4 hour candle transition to M15. This is 4 hour time frame. This is 15-minute time frame. In M15 now, this same candle that you're seeing here is the same thing here. I hope you can see the transition. Let's see what happened there. The body, the frame, you can see the frame here like this. You can see the frame. That if we have marked it in 4 hour, definitely when we turn to M15, you will still see your marking. You will see what you mark. That is if you are in the live market. So, but this is a schematic diagram. You can see the body. You can see the wick telling you the story that price actually come here. So now, every 4 hour candle has some candles inside it when it comes to M15. That is telling you that composition, what 4 hour candle composed of, how many candles in 15-minute time frame will be inside a 4 hour candle. That is 16 M15 candles. That is what we call candle composition. 4 hour candle will contain 16 M15 candles, because how many 15 minutes is in 4 hours? There are 16 15 minutes. That's the mathematics you will do. Daily candle contains 6 4 hour candles, and that same daily candle contains 24 1 hour candles, because there are 24 hours in a day. 4 hour candle contains 16 M15 candles, and that same 4 hour candle contains 4 1 hour candle, because how many hours in 4 hours? Exactly 4 hours. 1 monthly candle contains 4 weekly candles, and the same time that monthly candle contains 30 daily candles. We need the knowledge of composition because it's going to help us when it comes to technical analysis. When it comes to what? When it comes to top-down analysis, or multi-time frame analysis. When it comes to multi-time frame analysis, we need the knowledge of the composition. So we see the structure I drew earlier. Open, a price is open here. It first of all go up as if it's going to go bullish. It retraces to this low first, right? It retraces to this low first. Give us a high. Then that's the highest point it reached within this 4 hour window. It come back to close. We see that's the same structure I drew earlier. So that's the composition. I'm just showing you how it transitions from days to days. This is 4 hour time frame. This is 15-minute time frame. It's the same candle, but when you go to 15 minutes, you're not going to see this frame again. The frame will disappear. The wick will disappear. This is what you're going to see. If you did not mark it, it will now be looking confusing to you. All right. So that is the 4 hour candle. Among the components, one thing I forgot to mention is the reason why we study the component is because one component is key to our entry criteria. One component is key to our entry criteria, and that component is the opening price. In a bullish scenario, this is the opening price from below. In a bearish scenario, the opening price will be above and the candle will be red. So this component is key because it is what we are going to be using to enter trades. That's where we're going to be buying or selling from, right? There are other key levels in the market that we can buy and sell from, but this is the only one we want to stick to. Of course, there are other key levels. We have mitigation breaker, FEG, in fact, all PDRs are key levels. I said I want to, as much as possible, do away with unnecessary information. So do not crack your head that, okay, what is PDRA, what is mitigation block, what is breaker block? Just forget about it. What we wanted to focus on is this particular one, opening price of 4 hour candles. Focus on this one. Yeah. So it is key to our entry criteria, and that's where we studied component to know what is the opening price. This is the opening price, this level, this is the opening price. So this is the composition. Now the structure I drew earlier, when we come here, the formation of these candles give us what we call trend. See candle A, candle 1 I mean. I hope we can see clearly. It open, it gives us a low, high, close. The closing of candle 1, right, is the opening of candle 2. The same level where candle 1 closed serve as the opening of candle 2. So candle 2 open at that same level where it closed. It first of all create a low, high, close. Candle 3 open there, open, low, high, close. The next candle open, low, high, close. I hope you can see. So that's what gives us the structure that we're talking about. It's the formation of these candles that gave us the structure we are talking about. You can see the structure now giving us high, higher, higher, high, higher, low, higher, high, higher, low, higher, high, higher, low. This is a simple structure though, but it's the formation of the candles that give us this structure, and this is an uptrend, right? The same way, in a bearish scenario, we have open, high, low, close, opposite. We see here, this is a bullish and open, low, high, close. For bullish, open, high, low, close. For bearish, so it's directly opposite. Where candle 1 closes is where candle 2 open, high, low, close. Open, high, low, close. The same way, but in an opposite direction. I hope you understand this structure. So this is what gives us the structure, market structure that we do study. That open, higher low, lower low, higher low, lower low, higher low, lower low, and the rest. I will hope you understand these basics. All right. Now that we have understood the components, the composition, and structure, there are 3 types of candle we are going to look at. We are going to look at 3 types of candle for the purpose of this very entry criteria. There are other types, but we'll limit ourselves to these 3. The very first candle we will be looking at is a directional candle. A directional candle. A directional candle. And this is the only type of candle we want to enter from its opening price. We don't want to enter from the opening price of any other candle rather than a directional candle. So we can see a directional candle here. Candle A is a directional candle. What is the characteristics of a directional candle? You can see it has a longer body relative to the wick. The wicks are very small. The wick on top is small, the wick below is small, but the body is long. This is showing us a direction. It's showing us that it's ready to push it up. It pushes up and close with longer body, right? So this is a directional candle in this case, and this is the type of candle we'll be using as our entry. We are not going to use candles like this or candles like this. I'm going to come to these 2 candles. So for this is bullish scenario. In the bearish scenario, to be the same, but the representation will be red for a bearish scenario. The opening is here for bullish. The opening will be here for bearish, and this time it will be red candle, right? So this is a directional candle. It is a candle that have longer body relative to the wick. The wicks are small. The next candle is what? Indecision candles. These candles were not, I just showed it here, but we will not have any reference to this candle. So the wicks are what? Long. The body is small. It's telling us there is no any decision. No, it's not ready to do anything. Price is just accumulating here. And this is reversal candle. Okay, this one is going to help us more because at every swing point where price is trying to reverse, this is telling us a story that I am about to reverse. Price is about to reverse. So when you see a reversal candle this way, there's a story it is telling you that price is ready to reverse at a swing point. Pay attention to this one. This is the one we are using for the purpose of this entry criteria, the directional candle. This is also so important. It tells a story a lot at swing points. All right, this is the type of candle we will stick to, right? Candle A, directional candle. Let that stick at the back of mind. Directional candle. It is opening price. All right. We have discussed components, composition, structure. Let's go to market structure now. That is the second aspect in part 1, market structure. But before we discuss market structure, there's no way I can discuss market structure and not talk about storyline and narration. Storyline and narration, because there are 2 sides of the coin. There are two sides of the coin. I can explain market structure and not talk about storyline, and I can't explain storyline, phase, and objective without talking about market structure. There are two sides of the coin. All right. So I've said earlier that if you want a deeper knowledge on market structure, I have a video on this channel. I posted it over a year ago. I discussed it into details there, but the entry criteria I use there is different though. So what you're going to do is watch only the first 40 minutes of that very video. It is tagged market structure in this particular channel. I have a total of 5 videos now. So I posted those videos over a year ago. It's the same structure we're still using today. The structure have not changed. The only thing that changed is the entry criteria. So go and watch the first 40 minutes of that video for you to understand structure properly. But I'm still going to do a brief explanation here for you now. This is market structure. You already know how this one come about. I've explained open, low, high, close, right? You see, this price open here, it gave us a low, it go high before coming to close. So this is the exact open, low, high, close that is forming a trend. This is uptrend, this is downtrend. All right, but when price is forming like this, it has its own components too. So we wanted to discuss its components now. We want to discuss its components, right? So let me walk you through what exactly you are looking out for. Okay, let me tell you what the components are before we discuss what you are looking out for. When you open your chart and you see structure like this, the component is, it has a strong low, a strong high. All these are strong lows in an uptrend. Strong lows, but they are major lows. So in an uptrend, every major low is a strong low. You can write this down. In an uptrend, every major low is a strong low. In a downtrend, every major high is a strong high. Why? Because they are very strong to the extent they will break structure, not previous structure. The main structures, they will break them. A, C, E, G, they break major structures. L, N, P, R, T, they break major structures. So they are strong. You see here, B, D, F, H, they are weak because all these ones break them up. Then K, M, O, Q, S, they are weak here too in the bearish trend. They are major, but they are weak. All right, A and B, the very first component I said they are major, strong. They are major structures. They have major structures and they have minor structures. That's the first component. They have major structures, they have minor structures. The second component is they have impulsive phases. A, B is impulsive. When price move like this, when price move from A to B, that is an impulsive move. Impulsive move. A to B impulsive, B to C corrective. I believe you see what my cursor is. A, B impulsive, B, C corrective. C, D impulsive, D, E corrective. E, F impulsive, F, G corrective. G, H impulsive, H, I corrective. I, J impulsive, J, K corrective. Okay, for this case there is change of character. So why is this place impulsive? This is an impulsive phase because price moved from a strong low to a major high. So that is an impulsive leg. That's an impulsive phase. Then it reacts to an institutional level here and it corrects itself. I will explain these details later in the video about institutional reactions, reaction to institutional levels. I will explain it later in the video. I hope you helped me. So impulsive phase, corrective phase, impulsive phase, corrective phase, impulsive phase, corrective phase. You get to understand it better. In every impulsive leg, there are minor structures. 1 is a minor structure. 6 is a minor structure. Minor, high, minor, low. 2, minor, high, minor, low. 3, minor, high, 8, minor, low. Because they are internal structures. They are not major structures. They are minor structures. They are minor reactions, They are minor reactions. These are major reactions. All the major highs, they are major. They started from a major reaction. They reacted to institutional supplies from the previous price action. So they are major reactions. The minor ones are minor reactions. You get to understand it better. But this is the component for now. So when we open our chart, you can write this. We can write this down. Let me tell us what we are expected to look out for when we open our chart like this. First of all, we are going to find out what is the current phase. because this is a complete, what's it called, structure. Maybe we just come to the market, we find price here, we don't know what to do. Are we to buy, are we to sell? So what you're forced to do is, what is the current phase of price at this very moment? After you have found the buyers, what is the current phase of price? Because when you find the current phase of price, that phase will tell you what the objective is. And when you know the objective, it will help you frame your entry. It will help you frame your entry, which means you are going to help price to achieve its objective. After you have found the buyers, you have to look for a directional candle that is in line with that objective to help price achieve that objective. If you go against that objective, that is when you hit stop loss. All right. So you have to find out what is the current phase of price at this moment in time. Is it an impulsive leg? Is this an impulsive phase, or is this a corrective phase? Is it an impulsive phase, or is it a corrective phase? So what are the things you're going to do to help you find the phase? Is what is the last recent strong low? This is price narration now. You go back to the previous price action, because this is a schematic diagram. You go back to the previous price action. What is the last recent strong low? You mark out your structure after you have determined the buyers, that this is a bullish buyers. Where is my last recent major high? Does it break structure? This is my strong low break structure. You are doing this on 4H. You are doing this on 4-hour time frame. So you determine the phase first. When you now determine the phase, that phase will help you know what the objective of that current leg is. If it is an impulsive leg, the objective of every impulsive move is to create a major high in a bullish trend. If it is a corrective move, that is BC, the objective of every corrective move is to come and sweep liquidity of the internal structure before it will continue. If you find price at C after the end of a reaction, that is another strong low created. The phase helps you, tells you a story, helps you determine the objective. What is the objective of C now? Is to create a new impulsive leg. So the objective of that strong move is to create a new major high, because the overall objective of this pro trend has not completed yet until it mitigates a weekly open or daily open, as the case may be. No, weekly open. If it is a 4H pro trend, until it mitigates a weekly open. All right. I'm also going to explain this in details later in this very clip, if I have the time. All right. So basically, this is what you're going to do. Determine the impulsive phase first. Determine what phase you are in. Is it impulsive? If it is impulsive, what's the objective of impulsive move? This will help you find what? Candles, directional candles only, that is in line with that phase. In line with the objective of that phase. That is in line with the objective with that phase. If it's an impulsive phase, you buy until price gets to B. You will find a region that you know, oh, it may likely reacted to maybe a daily open or weekly open, as the case may be. Right? Then once you get to the daily open, you should expect a major corrective move, a major reaction that will start a corrective move. If price has started a corrective move, you should know that the objective of that corrective move is to come and sweep the inducement, the internal structure. So you're not going to sell anything until that objective is complete. And if that objective is complete, it will now, and it show intent of moving up, then you will know that, oh, another impulsive move is about to start. The objective has shifted. I'm following it up now. I believe you understand what I'm explaining here. So after I've done all this, you now find directional candle that align with that objective of that phase. You'll find directional candle that is aligned with the objective of that phase, and trade from its opening price so that the overall pro trend of that phase will achieve that objective. You are helping price to achieve the objective of what the overall pro trend want to do. You are not trading in line with it, but you must understand structure. You mark the structure correctly, then you determine the phase you are in at the moment. Once the phase has been determined, you now find the directional candle that is in line with the objective of that phase. If you do not find the directional candle at that moment, it means there is no entry for you. So all in all, we discuss here ACE, ACEG, right? The components there, these are all what? Strong major lows. Strong major lows, ACEG. Even I too is a strong major low before it become invalidated. But it's still a strong low because it broke structure before it later become invalidated. BDFGH. these, they are major highs but weak highs, right? Then the internal structures, the 1 2 3 4, they are minor structures, so they are internal structures, right? The internal structures. The same way, JLNPRT, strong major highs, QMOQS, weak major lows. QM, when you practice, you understand what I'm trying to relate to you here. So this is basically a market structure. You want to understand the details of how this form, right? Go to that my video, and how this major highs comes about, the internal structures. Of course, you get details there, right? So let me remove one, what's it called, range here, and give you a total explanation of what I've just explained there. We can see it here. So it's actually a range, or you call it a continuation pattern, because price will continue to do this again and again and again, right? We call it a continuation, but you continue to do this again and again and again, right? So you can see. So that's, I've just removed one, and to explain to you in details what the components are. This is a strong low, a major high, a strong low, strong low, strong low. This one will now continue with another impulsive leg. A new strong low have been created. It will do the same thing, create internal reaction, flip it, then come back to sweep. So this is an impulsive phase, corrective phase, impulsive phase, corrective phase. This is for uptrend, this is for downtrend, directly opposite. I hope you understand this. I hope you understand this. All right. If you understand this, I think we have done justice to part 1. I said I'm only going to explain it briefly. Let's go to the main reason why we were here today. That is using 4H candle as entry. We already know the type of candle we'll be looking out for, directional candles. All right, let's proceed now. Yeah, let's proceed. All right, we are done with the very first part of this section. We are now diving into the second part, and I said it's because of this very part we actually create this very module. So you have to pay proper attention here. We just finished learning how candlesticks help us to create trends, right? From their formation to what they are composed of in higher time frame, and how those formations help us to create uptrend and downtrend. And you can see the frame here. It's the same frame we have just talked about in part 1 that is still here. The only thing that I employed, like I overlaid the schematic, what's it called, candles on top of that frame now. So I want to explain to us how we can frame our entry using 4-hour opening price. I want to explain to you how we can frame our entry using 4-hour opening price. So it's still the same impulsive move, corrective move, impulsive move, corrective move, impulsive move, corrective move. So this is a bullish scenario. A trend, as we from the previous projection, a corrective move have ended. So that signifies to us that this is a strong low. How do we know it's a strong low? From our narration, impulsive move. We have determined the bias. This is a 4-hour pro trend going up. So a strong low has been created. What's the objective of every strong low? Is to create a major high. So this is an impulsive leg, right? Now, candle closes bullish after a reaction leg. When this candle closes bullish, candle A closes bullish, is a directional candle. Then candle B opens. The main candle B opens. We expect candle B to retrace to the opening price of candle A and find support. If it eventually retraces to the opening price of candle A and finds support, we are buying from there, because candle A just start an impulsive leg, right? So objective of every impulsive move is to create a major high. Candle A just started the phase. In this phase, we are going bullish. Every directional candle that is fine in this leg, the opening price of it serves as a strong support, and that's when B retraces first. We come back to pick orders from the opening price of candle A and we buy from there. And what did B give us? A bullish move and closes. All right, when B closed now, candle C open. Candle C did its thing. It did not come back to the opening price of candle B, but it closes bullish. Meanwhile, as it is closing, it reacted to an institutional level there, a minor reaction. And that's where we have candle D and E closing bearish. So when you have a pro trend going up, and some candles are closing bearish within that pro leg. It's as a result of a reaction to the institutional levels. I'm going to explain this reaction later in the video. Be patient with me now, but just know that candle D and E closes bearish as a result of reaction to the institutional levels. So that reaction is what created a minor pullback. That is a minor reaction. So candle DE closes bearish. E finds support at the opening price of candle B. Why? Candle B is still a directional candle and it displaces above the high of its previous candle A. Are we together? So we buy from opening price of candle A, candle B, and candle F open. It gave us another directional candle, right? Then the trend continues going up because this impulsive leg has not completed its objective yet. The only time it will complete its objective is when price reaches B, because B is an institutional level we already marked and we anticipate that price is going to reach there. So candle H open retraces to opening price of candle F. It finds a strong support. We buy and it pushes up. Candle I open, it didn't come back to the opening price of candle B before it completed the objective. So candle I tap on that institutional level. It gave us a major I. Objective is complete. Objective is complete. Now that the objective is complete, we do not expect to buy from opening price of candle I anymore because objective of that leg has been completed. See the logic. We do not expect to buy from the opening price of candle H anymore because objective of this entire impulsive move is completed. The next objective is to move price from B to come and sweep liquidity of the internal structure. That is the corrective move. Impulsive, corrective. Are we together? So this corrective move now, whatever you do, if you buy here SL, because it is a new objective entirely, what you're going to do, you're going to be selling from the opening prices of the candle that closes bearish with body displacement, the directional candle that closes bearish. You sell from the opening prices at resistance level to help price to achieve its objective of sweeping liquidity here. Are we together? Are we together? All right. So candle J open closes bearish. Candle K open a directional candle. And when candle L open, it go back to the open which serve as resistance level. The candle K open serve as resistance level and it target and sell, right? And sell. 1, 2, 3, go. A, B. And serve as resistance level and sell. Because the opening candle of candle K serve as resistance level here, candle L tag on it and sell. And when candle L closed, what did candle M did? It opened, then closes as directional candle and help BC achieve its objective. Because once it has sweep liquidity of the internal structure here, the objective of corrective move BC is complete. Now, at the end of each reaction leg, a new candle that form, right? Whether it's a directional candle or not, the opening price of that candle is high probability. So far, the pro trend has never mitigated any weekly open. The 4-hour pro trend is still bullish. So any green candle that signifies at the end of it a reaction leg closes bullish, the opening price is a strong support level. That's why when candle N open, after candle M help BC achieve its objective, the opening price will buy from there and see what it did. Candle AO open, tag the opening price of candle M, and now it pushes bullish. The reason why candle N, we did not wait for it to be a directional candle, probably closes above the high of candle M, is because we saw it at the end of a reaction leg. This is a minor reaction, this is a major reaction. So any candle that form at the end of a reaction leg, the opening price is high probability. It's high probability. So that's why we enter from the opening price of candle N, and candle O gave us the profit required. After candle O closes, candle P open, reduces a small, and it's also going up. This is a new impulsive leg now because C is the new strong low. I hope we are following. I hope we are following. C is a new strong low. So this continuation pattern will continue to move up until the overall objective of this 4H leg is complete. And we're not going to assume it's going to change character or shift in structure until it tag on the previous price action, the weekly open. Once it tag on the weekly open, that is when we should anticipate a change of direction. Even though it tag on the daily open, all the daily opens, they are going to be reaction only, major reaction. They are only going to be major reaction until it get to the weekly open. That is when we are going to anticipate a change of direction, whether bearish or bullish, until it get to the weekly open. I'm going to explain that aspect. So when we get to institutional reactions, when price react to the institutional levels. All right, the same way when it comes to a bearish scenario, price reached a strong high, like this is a reaction leg from the previous price action. It created this structure A. We confirm A to be a strong high because structure A here, not candle A, to be a strong high because it helped the previous structure complete its objective, sweeping liquidity. Now when this A is forming, right, it closes bearish. That signifies that a new phase have started. A new phase have started. This is a strong high, then this is a new phase, impulsive leg, but this time around bearish, impulsive corrective. So when this candle A closes bearish, we are going to wait for it at the opening price because it's the new resistance level we are selling from. I hope we are following. So candle B open, it retraces back to opening price of candle A and sells from there. So it sells from there and closes bearish. That's the profit that's giving us. Candle B is a directional candle with body displacement. When candle C now open, it retraces back to the opening price of candle A. It is a directional candle. It also serves as a stand level, then sell. So far, this impulsive leg, the objective have not completed yet. For objective to be completed, it means when price reach B, B will react to an institutional demand here, right? So any directional candle that is in this leg will be selling from their opening prices. Candle C reacted to a minor reaction, have a minor reaction in relation to an institutional demand here, and that's what results to creating of candle D to close bullish. But that is just a reaction because the objective is of this leg is to create a new major low. See the logic. We are not going to enter from the opening price of candle D, thinking okay, it is a directional bullish candle, maybe price wants to reverse. No, until the objective of this leg is achieved. Now when we know that this is just a reaction, candle F open, it closes with directional candle with a body displacement. We enter from the opening price of it and it sells there. So this scenario will continue until the overall objective of this impulsive leg is completed. When the objective is completed, we now follow any directional candle that is in line with the objective of the corrective move, which is BC. It will push us up to sweep the liquidity of the internal eye. Are we together? Are we together? All right. So now that we have know how to frame our entry using 4-hour candle, the opening price of 4-hour candle, let's look at some of the things we need to see before we know that this is high probability or this is not high probability. I have explained that whenever we find a candle at the end of a reaction leg in an impulsive move, at the end of the reaction leg, that bullish candle, whether it has a body displacement, whether it's a directional candle or not, the opening price is always high probability. So candle F, candle N, we found it at the end of a reaction leg. This is a minor reaction, this is a major reaction. A minor reaction, a major reaction. Candle F close bullish after a reaction leg. Candle N closes bullish after a reaction leg. The same way candle D, right, was the reaction here. Here all the candles that gave the reaction leg have bearish candle because price was bullish. When price is bearish, the reactions candle will be bullish. I hope you understand why it's so, because this reacted to an institutional demand. So any candle that closes green here is just a reaction. The overall objective is bearish to come and form a new major low. All right, so this is what I wanted to explain here. We see this candle here. Whenever a candle closes with body displacement above the high of its previous candle, that candle is high probability to buy from for a bullish scenario. And whenever it closes below the low of this previous candle, it is high probability to sell from. So look at this scenario: candle A, candle B. Candle B is a directional candle. Candle B closes above the high of its previous candle A. See the body closing above. Had been the body closes like this within the range. What I mean by the range, the low of candle A, the high of candle A, that is a complete range. Now, if the body closes outside the range, that is above the high for a bullish scenario or below the low for a bearish scenario, then it is closing with a body displacement. The distance from the high to where the body closes is what we call the displacement. If it is in a bearish scenario, the distance from the closing of the body to the low is what we call the displacement. So once a candle displaces above the high or low of a spiritual candle, it is a high probability candle to enter from its opening price. For a bullish scenario, opening price above. For a bearish scenario, I believe you understand what we mean by displacement now. So when we find a directional candle that displaces above the high of previous legs, previous high or low, as the case may be, they are high probability entry for us to trade from. I hope you understand what I've explained here. All right, so let's move to the live market. Let's see some examples of what I've just explained. Okay, so this is V75. I'm a synthetic trader, and I'm going to take us through some of the few trades I took in the past, and I've not cleared the chart. Some couldn't pick, and some picked. But what I want to assure you is that every entry here are from opening prices alone. That is basically what we're trading in Zenny Trade now. Opening prices alone. All right. So these are the few trades I've not cleared their previous buys that I've placed. Let's do a little analysis here. From structure, high, low, major high, major low, minor high, minor low, for us to determine how we're able to frame these entries. All right, so this is 4-hour time frame. As you can see here, I've marked these places from the higher time frame before the daily time frame. So these are daily opens. Let's start our analysis from some of where we have this, what's it called, tools placed in the opening prices. So let's start from here. Since a price finds support here, what this place is a major strong low. It is a daily support. You can see I've marked it before, daily support. So since it's a daily support, it's a major strong low, and when price get there, we can see what price did. It pushes up, right, with the directional candle. When price was falling like this and get here and pushes up, okay, creating this candle alone tells a lot of story. Price is ready to reverse. So this is a strong low now. This is a strong low. So from the structural knowledge we've just learned, minor high, minor low, major high, major low, strong low. This is a new strong low corrected. From here, this is a new strong low. So we can see the M. In my structure video I posted, the one I asked you to go and watch on YouTube, you can see I said you always picture your structure in form of letter M for bullish scenario or letter W for bearish scenario. You can see the M is out now. I just mark it. So let me take it back. The next one we can see this is a new strong low and another impulsive leg I've started, but here we have a major high created because it draw liquidity, then it created a minor low. This major high could not break the structure above, so If the major I could not break the structure of my anticipation is it is ready to change character, right? It's ready because you could not draw a bow on top of this liquidity. It's ready to change character this way. But coming down, I discovered that it did not break the low, the previous strong low. So definitely the pro trend, the bullish pro trend is still active. So that's why when it first of all sweep liquidity here, right? No, when it mitigate this place, my anticipation will be that okay, it will continue to go. But this high did not sweep liquidity. It did not draw above this. Did not draw on liquidity. Definitely, I am expecting this should only be a reaction. This should only be a reaction. So this is a reaction. Then this is a full leg now coming here. This is a new strong low. This is a new strong low. So look at another letter M. Okay, I couldn't draw it together, but it's also formed letter M from here like this. You can see the structure there. All right. So look at this one. Okay, this will have series of minor structure inside. Series of minor structure inside the new strong low. Minor high, minor low, major. It closes above it. The new strong low. We can see we are forming M's, right? Just the way I said you should picture your structure, you can see it. Then the new, what's it called? Impulsive leg started. All right, I believe you understand what I'm trying to mark out here. You have to train your eyes for you to see this. It's not going to look exactly the way it is in the schematic diagram or the way it is in your textbooks, but if you practice consistently, believe you me, you get it up with clarity. Now let's see how we enter each of the trades we took. Let's see how we frame our entry. Now that we have know, okay, it is a bullish move, and since it is a bullish move, we will look for directional candles that we're going to enter from its opening price to help price achieve each of its objective in each of the phases, right? So let's see how we enter each of them. Let's see how we enter. We started from here, right? So look at these candles here. None of them come back to the opening price. They are directional candles, but did not return. If they did not return, no entry for you. When they come here, it created additional candles. After the additional candles, it created what? A directional candle. It mitigate, but have not drawn liquidity yet. When price returns to its opening price, we buy. It gave us the nice profit. I hope you can see. After giving us the profit, we exit. The next directional candle did not also draw liquidity. Okay, draw liquidity here, but at least we can see a form of trailer liquidity here. It has not drawn the overall liquidity, so it's still a directional candle. We enter from its opening price, give us the result. Though it did not go on time because because of this small liquidity, this reaction was a kind of strong, but it showed reversal sign here. Then it gave us another candle. I didn't enter this, but market it hold going up and see until it reached major high. Minor high reaction, major high. Now after drawing on liquidity, you can see this candle here showing sign of reversal candle. The one I told us that okay, at in swing leg, we are going to it's going to help us tell us a story each time when price is about to reverse. That's what it did here. That's what it did there. So this one draw liquidity, this institutional level of market, you can see a new objective is to come and sweep the liquidity of the low, right? Or the liquidity here. And when this directional bearish candle open, it closes. I wait for it, didn't come. I have to be patient and be disciplined. A next opportunity will come. This one is not a directional candle. That's why I mark it, but I didn't trade it, but respect it. This one is a directional candle, almost mitigate, but I've not drawn liquidity yet. Yeah, that's a mitigation. So I also waited for what? It didn't come. Then this one, the green candle is a reaction. It did not displace above the high of this. Then this red candle displaces below the low. I know that yes, it's not yet ready to go bullish. Probably it will test any of these 4-hour candles that was created here, the opening prices, and that's exactly what it did. I enter from the what opening price of this candle red, and that's what gave us this. Now testing this, I wouldn't have known if this is the opening price with respect or this, but tapping here, it gave us 2 reversal signs candle. I hope you can see. Let me zoom this very well. Let me zoom this very well. Let me zoom this very well. I hope you can see, because this is a very important aspect, right, that you need to understand. See, it gave us two reversal candles telling us I'm about to reverse, I'm about to reverse. And after that reversal candle, it gives us the directional candle, right? After it closed, we wait for price to retrace to the opening price and we buy. And see that swift move, impulsive move, because this is a new strong low now. So these directional candles it created, none of them come back to the opening price. We'll be patient until it get to the sipping drawing on liquidity. It did not give us a room to enter. Okay, here it mitigate. When a directional candle mitigate without drawing on liquidity, you can actually enter from its opening price, and that's what we did here. You see, that's what we did here until it draw on liquidity proper. And after drawing liquidity, any candle that have drawn liquidity, you are not entering from its opening price again, because objective of that move must have likely be completed. So if a directional candle draw on liquidity, we are not entering from its opening price. If it is mitigate, that's when we are entering from the opening price, maybe to help it move further to complete the objective, right? So here we did not enter from the opening price of this directional candle. We can see, even though it entered just a small reaction and it failed. Now that it's failed, so this is open high. I told us that this one could not break, but we know that this is a minor reaction. It tapped on the opening price of this directional candle, is gave support sign. The next directional candle after reversal, we enter from its opening price, and that's what give us this swift buy. Are we together? That's what give us this swift buy. Yeah. So look at what happened here. Rejection block. It gave us a directional candle bearish. If you want to enter from the opening price and put your stop loss here, you can still enter from it, right? And price begin to, and here none of these candles price retrace with the opening prices. We need to be patient, right? And when price drawn this liquidity, it mitigate this place, this rejection block, retraces right up. As it's retracing up here, that's what I say. Okay, since it did not go above this, since this could not break this to give us a major high, probably there will be a change of character. So you have to be patient, because this high could not break this high, right? Remember that this is a form of a minor reaction, expecting a major, but it could not go. So definitely we expect price to continue like this, right? So you have to be patient, and definitely this was actually a reaction, because this was a mitigation. So it reacted to this rejection block. As a result of this rejection block, pushes price, this one closes green, thinking to continue the bullish move, and see it is just a reaction. And after it closes bearish, the next directional candle, we waited for it at the opening price, but we could not pick. We could not pick. You have to be patient. When you follow this rule strictly, believe you me, you will filter out losses completely. You could not pick. Then, since we anticipate that, okay, it might broke this structure, this strong low, this is the previous last strong low, the price will respect. If it's going to, if the pro trend, the bullish trend will continue, and it's respected. So when we waited for it here, it could not pick. It created a new directional candle. We enter from it, it peaked. It gave us partial profit, and tells us that, oh, I'm not going down. Oh, it come up with the directional candle, flip it up, and after this flipping, we know that the pro trend will continue, because this strong low is respected. It cannot be broken. Then we continue to follow it up. So the next directional candle opening price, the next directional candle opening price, until I have to come and draw liquidity here. The next directional candle opening price, even this one here, opening price, right? It hold. The next directional candle here, opening price. Next directional candle here, opening price. Everything here is opening price. Everything here is opening price. I believe we understand how we frame entries using the opening price. As it is going up, they are serving as strong support levels where you enter from until you draw on liquidity. So this is a new strong low, a minor high, minor low, major high, coming back to sweep liquidity of here, right? Opening price. And after this have been swept, the new directional candle going up, a new impulsive leg, Look at, we waited for it at the opening price, did not come. We have to be patient. We're not going to FOMO to enter. If it didn't pick, it didn't pick, right? So none of the one come back to the opening price of all these directional candles. Here it has not mitigated yet. It has not drawn liquidity yet. That's why we enter. It come back to the directional candle of this. Since it is mitigation, it has not drawn liquidity yet. We follow it up. Then we follow it up, drawing on liquidity. We are not trading from any of this opening price because definitely we know that objective must have been completed, and that's exactly what it did. None of this opening price respected after drawing on liquidity. I hope you can see. I hope we can see. All right. So as it is coming down now, it's a new objective entirely. We have to be looking for directional candles, right? That will help us achieve the objective of this bearish move. That will help us achieve the objective of this bearish move. All right. This was just a reaction. It reacted, turns back. We can wait for opening price. It didn't come, and the one that come, that's where we're going to trade. We just put your, what's it called, once you see a directional candle have closed, put alarm at the opening price of it. If price come back, alarm we alert you, then you place your trade. Put your, what's it called, alert at the opening price 35,220. If it eventually come, it will alert you, you place your trade. Yes. So this is a reaction too. This whole move is a reaction. Then after the reaction leg, the candle that turns bearish to continue the pro bearish trend, put your, what's it called, alarm there for price to retrace to it to continue the pro bearish trend. You see, and that's exactly what we did. All the entries here, we can see they are all opening prices. They are opening prices. I believe you can see our frame entries, right? Using these opening prices until the price gets here, and I think these are daily open, right? Okay, yes, daily open and serving as support. Price definitely even here too, but did not respect it. This daily open too. There are sometimes it failed, yeah. So it did not respect this daily open, but respect this one, and price eventually returned going up. You see price going up here, right? Look at what happened here. Everything here is what is opening prices of 4H candle servers. Let me zoom it very well so that you can see it with clarity. You see, they are all directional candles going up, opening price, going up, opening price, going up, directional candle, come back to the opening price. Or see, after the reaction, directional candle, opening price, reaction. Okay, there's no reaction here, but this opening price, this one did not come here. They definitely, this one mitigate opening price hold, going up. Reaction, at the end of reaction, we have directional candle, opening price of it. Can we see? This is a reaction to institutional level. We come back and probably maybe this daily open, we don't know, but this is a major reaction. All these ones are minor reaction, a major reaction, and this major reaction was still a mitigation. It is not sweep any liquidity, but a directional candle form, opening price, and it pushes up. Are we together? So this is how you're going to use 4-hour time frame to frame opening price, to frame your entries, and make sure the candle you enter from is in line with the pro trend bias, so that it's going to help you achieve the objective of that pro trend. All right. So all what you see here is opening prices. Opening prices, and they are all directional candles. If you go to your chart and also look out for this market on 4H, go to M15, place your words buy to or sell to, backtest for test. You'll find out what I'm showing you now that is 100% true. This is a live market. Everything here, reaction to institutional supply. At the end of the reaction, directional candle enter, reaction, directional candle enter, reaction, directional candle enter. Simple as that. This is reaction to institutional level, directional candle enter, reaction, directional candle enter, reaction, directional candle. Okay, this one did not pick. So going up. Here price was very bullish, right? Price was very bullish. Price was just reacting to the institutional supply. After the reaction, any directional candle we find, we enter from it. Directional candle enter, directional candle enter. You see? Okay, this is a recent price action. All right, this is how we enter from each of the directional candles that is in line with the pro trend objective. All right, let's go to the relationship between this directional candle's opening price and time. There's a relationship between these directional candles that we are entering from, their opening prices, and time. We have 4 expansion windows. So let's go and look at that now. Yes, there's a relationship between these expansion candles, directional candles, and time. We have 4 expansion window for synthetic traders. The expansion window for all markets, being currencies, that is people trading currencies, forex, commodities, stocks, and the rest. For about synthetics, I'm only going to be talking about the expansion window for synthetic indices. So these expansion windows, they are the period of the day when we are likely going to experience an impulsive move. The period of the day when price we end a major reaction and we like to continue with the pro trend where price is going. The period of the day when price will end a major reaction and they are likely going to continue with the pro trend. You see that price will come and tag your 4H opening price at these very hours, at these expansion windows. In every 24 hours, we have 4 expansion windows. We have 4 time price will likely come and tag your 4H opening price for it to continue with the pro trend, either bullish or bearish, right? So if you monitor your chart and price come to this, your opening price at these very hours of the day, it is likely going to hold. And once it peaks, it's going to move impulsively. That's what I'm telling you. It can be in a bearish move and bullish move. It can be in a bearish move. So what are these 4 expansion windows? Well, the very first two is 9:30 a.m. in the morning, 9:30 p.m. in the afternoon. GMT, that is Greenwich Meridian Time, London, UK time, 9:30 in the morning, 9:30 in the evening. But I'm a Nigerian, and for us in Nigeria, we are GMT plus 1. That is, we are 1 hour ahead of GMT time. That means anything we are doing, we will have to add plus 1. If you look at your trading view here, look at where my cursor is at the moment. At the bottom right hand side, you see I set mine to be UTC plus 1. That is GMT plus 1. So that 9:30 for us, it will be what? 10:30 in the morning, 10:30 in the evening, 10:30 a.m., 10:30 p.m. That is the very first 2 expansion windows. When price come to your opening price, 4-hour opening price at the very moment in time, it can be around 10:15, 10:30, 10:45, 10:15, 10:30, 10:45, and they target at those hours of the day. Believe you me, it will move impulsively. It will move impulsively. It can be in a bearish form. If the pro trend is bearish, it will come and target at these hours of the day and begin with the pro trend downward. If the pro trend is bullish, it will come and target at this hour of the day and it will begin with the pro trend in bullishly, right? In a bullish form, I mean, with swift move, with the impulsive move. All right. So as a Nigerian, 10:30 in the morning, 10:30 p.m. in the evening. Then 3:30 in the morning, 3:30 afternoon. 3:30 a.m. in the morning, 3:30 afternoon. If you are to reference it back to the GMT, I told you it's actually 2:30 a.m. in the morning, 2:30 a.m. afternoon. But we are 1 hour ahead of GMT. Then it is 3:30 for us in the morning, 3:30 in the afternoon. And if you are watching this video, you are not in any of these 2 time zones, you are not a Nigerian, and you are not also in the UK time, what you're going to do, just use your local conversion at 2 to convert what will be my local time when UK GMT plus 0 is 2:30 a.m. Once it give you your local time, then the AM and PM of it is going to be your expansion window, right? So the 4 expansion window we have as a Nigerian: 10:30 in the morning, 10:30 p.m. in the evening, then 3:30 a.m. in the morning, 3:30 p.m. in the afternoon. Those are the times price come to your opening price, and it will tag your opening 4-hour opening price and we move swiftly. I hope you understand the explanation I make. If you are using what's it called, MT5 is by default UK time. You cannot change it to UTC plus 1. You can see my here, I've adjusted my trading view to UTC plus 1. So that's why I'm seeing exactly 10:30, 3:30 in this case. So if on your trading view, your UTC, your timing zone should be what? UTC plus 1 Lagos. But if you're not a Nigerian, then confirm your local time and change yours to that your local time. Then convert the 2:30 a.m. GMT to your local time, and that's going to be your expansion window. I believe you understand what I just said, and you can do it as well. But as a Nigerian, if you're a Nigerian like me, our time is 10:30 in the morning, 10:30 p.m. in the evening, then 3:30 a.m. in the morning, and 3:30 p.m. in the afternoon. So let's confirm this. We're in 4 hours now. Let's go to M15. When we go to M15, let's see the time of the day. Most of these entries pick our 4H. Let's see the time of the day. Most of these entry pick our 4H opening price. Alright, let's go to M15. Alright, now we are at M15. We want to confirm the time of the day. They retraces back to our opening prices and peak. Yes, we want to confirm it. Look at this. This very first entry I have here. Let me place my cursor on it. That is 22:30. Exactly 22:30. That's 22:15. Sorry, 22:15. That is exactly 10:15. I told you it's 10:15, 10:30, 10:45 within that time zone. So if price come back to your 4 hour, these entries you are seeing is the 4 hour mark on the 4 hour time frame. So 22:15. This is 24 hours. So that is exactly 10:15 p.m. in the evening. 10:15 p.m. in the evening. I hope you can see. You can confirm that by yourself. Let's look at this one. This is exact. It come back exactly 22:30. That is 10:30. Look at this place. You look at this place to confirm the time. Look at where my cursor is. When I over my cursor on the on my entry, just look at the timing, the date and the timing here. So that's exactly 22:30. That is 10:30. That is 10:30 because this is UTC plus 1. If it is GMT plus 0, it's supposed to be 21:30, right? But this is 10:30 now as a Nigerian because I've adjusted my UTC to be plus 1. Alright, so it's not in all cases that has to be this 4-time window. If your candle is in line with the pro trend and you not come at this hour, you can also take your trade. But if it fall within this hour, that is when it become high probability. Look at when it peaks. Look at this impulsive move that it moves. Look at this impulsive move within a very short period of time. That's what we are saying. If you come at this hour, it will move impulsively and give you your profit without stress. So let's check the next one. It's not all cases that it will ram like this one. Let's see where did price come. This is 22. That is 10 o'clock. Okay, it did not arrive at our opening price at that hour here, but the very first we have checked. I hope you can confirm it yourself. So let's look at this one. This is this one too did not rhyme, but price come to opening price and peak. Let's check the next one. This is exactly 345, 330, but it not even peak. But the lowest point you get was 330. Maybe we have refined too much here. So look at this is exactly 3:30 in the afternoon. 3:30 in the afternoon. Check here. Look at the time here. Look at the time where my cursor is. When I over my cursor on the opening price, just check the date and time below it. So that's exactly 3:30. I hope you can see the timing. These expansion windows will work magic for you if you actually put it to use. 10:30 a.m. p.m. as a Nigerian, 3:30 a.m. p.m. as in the afternoon as well. These are the 4 expansion windows. Look at that one, 22:30. That is 10:30 in the night. 10:30 p.m. 10:30 p.m. That's the 22:30. That's when price come and pick my opening price. I hope you understand this. I explained to you now. I hope you understand this and you make use of this. That is exactly 10 o'clock. Price come and pick my 4 hour at 10 o'clock. So you don't need to be stressing yourself for you to be looking at the chart all day. Just come at this expansion window time and check things out. 22:15. That is exactly 10:15. That's when price comes. You come when it is exactly 30 minutes to 10, maybe at 10 o'clock, you come and check all your pairs you're trading. Which one directional candle is in line with the pro trend, and when is it likely going to tag my entry at that time? Look at this one, exactly 3:30 a.m. in the morning. You wake up maybe 2:30, then begin to check things out. Exactly 3:30, that's when it comes. I hope you can see. All right, so let's check this one. Okay, this one did not rhyme. This one did not rhyme, but it doesn't mean it will not play out. So, but the one that is rhyme with that 4 expansion window, definitely when they pick, they're going to move impulsively. They're going to move impulsively. Look at this one, 315. It come and target 315. It come and target 315. I hope you can see. So I can show you many examples as possible, and you see it yourself that these 4 expansion windows do a lot of magic if you really want to catch sniper entries with impulsive move. If you really want to catch sniper entries with impulsive move, right? If you really want to catch sniper entries with, okay, this one is this one did not rhyme, but the very first target, let me check, that is 2215, where price come first, like it come 2 times. The very first picking was 2250. That is exactly 10:30. That's exactly 10:30. I hope you can see it. If you don't know how to convert your 24 hours timing, 22:15 is exactly 10:15. 22:30 is exactly 10:30. I hope you understand it. All right, go and learn about 24 hours time. What's it called? Resting. So these are the 4 expansion windows as a Nigerian: 10:30 p.m. in the night, 10:30 a.m. in the morning, 3:30 a.m. in the morning, 3:30 a.m. in the afternoon. I hope you understand it. All right, this is let's go back to 4H. Let's go back to 4H. This is what's it called? V75 index. Maybe I should try as much as possible to show you a new pair so that you understand that okay, maybe I should show you a new pair later. I will show you another pair, right, that I'm trading, and also confirm this entry, the relationship between the expansion window and time. The relationship between expansion window and time. Should we move to institutional reactions now? Reaction to institutional level, or I should show you a new pair first? I think I should have to show you a new pair first. Let me try and show you a new pair first. Alright, this is volatility 75 1x. The very first one is volatility 75 index. This one is 75 1x index. So there's a difference. Now, there is no need for us to look at 4-hour opening price again. We have already discussed how we frame our entries, but let me do a bit of market structure as well, so that you can understand that how to approach the market in terms of structure marking is still the same thing. Okay, let me zoom. Maybe probably you're not seeing it very well. Let me zoom. Actually, what I wanted to confirm in this pair is those expansion windows, right? For you to know that in synthetic indices, the expansion windows are the same in all pairs. It's applicable to all pairs, any pair you're trading at all. But let's mark structure here. Let's mark structure here just to confirm impulsive. You see, this is strong low already from previous transaction. A strong low, right? Yeah, minor high, minor low, major, and coming to sweep. I hope you can see that. Then great series of impulsive of minor structure, and actually do not come back to sweep any of them until it mitigates. Is this a weekly resistance? Yeah, that's a weekly resistance. So I said this: whenever a pro trend is moving bullish or bearish, they do not anticipate that the objective will be finished until it actually mitigates a weekly open or a daily open. No, in this case, if it is a 4-hour pro trend, make sure it is a weekly open, because the daily opens are going to be major reactions. The 4-hour open will be minor reaction. They'll be reacting to the institutional levels. Maybe when I get back to what's it called, V75 now, where I present the slides, I'm going to show you details how you can do how reaction into institutional levels works, so that you understand it properly. But now it has mitigated weekly resistance, and that's how it begins with the bearish move. All right, but before that, you can see this is M structure. You have seen that, and this will have series of internal structure. It didn't give us room to create and to come and sweep them. All right, that's that about the structure on this pair. When this probably when we move ahead, we see that it will create series also those patterns. I mean, M in form of structure in form of M when it is bullish, and in form of W when it is bearish. But where we came here is for us to look at, you can see, okay, the opening price is the actually every on through here is also opening price, reaction, impulsive, directional candle we enter, reaction, directional candle we enter, reaction, directional candle we enter. The same thing when it was coming down after it mitigated a weekly resistance. Reaction, directional candle we enter, reaction, directional candle we enter, reaction, directional candle we enter from the opening prices. Now the reason why we come here module is for us to check the expansion window, right? Now let's go to M15. Since this is for our, let's go to M15 to see if it rhyme, if the timing of the day the price is coming to tag our our opening price is those 4 expansion windows I've discussed about. I said it might not necessarily be that time, but if prevention is come at that time, then it become high probability of a couple of what's it called for past 3 days now. I've not touched this pair, but here look at this here. Let's see, this is the forward mark on 4H. This is M15 now. This M15 now. Look at what's the time of the day price come and tag. That is when it is target first. That is 15:30, 3:30. I hope you can see that is 3:30 in the afternoon. As a Nigerian, mine is UTC +1. All my peers have set them to be UTC +1. So if you're doing analysis on MT5, of course you'll be seeing where you are seeing 15:30 now, it will be 14:30 because it's 2:30 GMT. So it will be 14:30. But if you have set it to be GMT +1 or UTC +1, then you should be seeing 3:30 as a Nigerian. That is 15:30, exactly 3:30 in the afternoon. Alright, let's look at this. When is the time? Okay, this is 22, that is 10 o'clock, in the middle of it, 10:15. So around that time, you can see that's when price come and attack within that time zone, 22, that is 10:30. So you don't need to enter market in all this accumulation period. See, price was accumulating throughout, but the moment it was time and it attacked the opening price, see that swift move. I hope you can see this. All right, when did they attack the opening price here? Okay, this one did not rhyme. This was 4 4 4. Okay, this one did not rhyme. It mustn't be those time window, but if it eventually come at those hours, believe you me, it will do well. This one attacked the opening price twice. The very first time it was 3:30 in the morning. You can see it clearly by your eye. 3:30 in the morning. So let's look at this. The time it come. Okay, this didn't rhyme. This didn't rhyme. But majority of the time you can see that it's actually in line with that expansion window. Let's check this and move to the next thing. This one is 3:15 in the morning. I hope you can see this. So make sure you actually put down these 4 expansion windows, and whatever you are doing, make it ensure that you patronize this expansion window so that you can catch moves that will not going to give you stress. There are some trades you enter, price will be accumulating for hours as a day trader before it actually moves. If you wait for this expansion windows, it is stress free. So I'm going to stop here. Let me go back to my pair so that we can continue. 15:45, that's when the tag. 15:30, that is 3:30. I hope you can see it by yourself. That's 3:30. All right, let's go back to my first pair where I have the slide. right? So that we can continue. Let's go back so that we can continue. Yes, let's go back so that we can continue. I believe just follow me. Do not fast forward any of this clip. I said it. Do not fast forward any part of this clip because you might miss out some important information. Yeah, so that is that about the 4 expansion windows we have in synthetic indices. Now, you have been hearing me talking about reaction to institutional demand, reaction to institutional supply. Let's discuss reaction to institutional levels, because if you understand that reaction, then it will help you in understanding how structure move, right? It will help you understanding how structure move properly, right? And it is going to be less confusing. You'll be hearing me talking about reaction since the beginning of the video, right? Let's discuss reaction to institutional levels now. So I'm going to use a schematic diagram, and since I've shown you what's it called, live market, you will get this explanation very easily. You get it very easily. So this is the normal market structure from the beginning of the video. The candle formation giving you impulsive, corrective. I don't need to dwell much on that now. Impulsive, corrective, impulsive leg, corrective leg, right? So what we want to like take notice here is what, how they react to institutional levels. Price move from 6, right, from this structure 6 here to A. 6 to A is impulsive move, A to 7 is corrective move. 6 to A impulsive, A to 7 corrective, 7 to B impulsive, B to 8 corrective. We already know this, there's no need for us to waste time. Now when 6 moved to A reacted to 5 before it begins its corrective move and pushes price to 7. Are we there? B reacted to 4, institutional supply, and before it pushes price to 8. C reacted to 3 before it pushes price to 9. D reacted to 2 before it pushes price to 7 or to 10. E reacted to 1 before it pushes price to off. I believe you are trying to get what I'm trying to explain here. The same way, when change of character happen, F reacted to 10, institutional demand now, before it pushes price to 11. Then 11 sweep liquidity of the I, pushes price again and break F. G reacted to 9 before it pushes price to 12. The same scenario, pushes down. H reacted to 8 before it pushes price to 13. Right? Now, I reacted to 7 before it pushes price to 14. J reacted to 6 before it pushes price to 15. So this is how reaction works. The previous price action by the left hand side, when a new leg is moving, it's going to be reacting to those institutional levels one by one, either major or minor. But for this schematic diagram, I only show for the major reactions. The minors are inside. The minors also react to institutional levels. Maybe these major ones now, they are daily reactions. They react to daily opens. The minor ones may be reacting to 4-hour opens along the way, but they are hidden. So this is how reaction happen. So when your price is moving and it's reacting like this, how is it going to help you to in knowing which candle that is high probability and which one that may likely not hold? So follow me closely. That's why I've come up with these schematic candles here, overlay on the frame, on the first CP of that impulsive 4H trend. Now look at this place. The very first candle we buy from, when we discover that okay, a new 4 leg has started, this pull trend has started, the very first candle we buy from, its opening price is candle P. Candle P ended come up and closes bullish, at the end of a reaction leg. When price move from 5 to 6, that is a reaction, of course, because when price was moving up, it reacted to an institutional level here, though it's hidden. Then before it pushes down and pushes back and break it, you can see. So at the end of that reaction leg, that's when P form, and P is a directional candle. We buy from the opening price. The next candle is V, right? It gives us profit. K open, it gives us a continue, the profit continue. Then K reacted to a hidden institutional supply level, and you see it gives us a minor reaction, and candle F closes bearish. I already understand this, I've explained this before. And after candle F closes bearish, right, candle X open, it turns bullish. That means the reaction has ended. It's just a minor reaction. At the end of that minor reaction, candle X become high probability. It becomes high probability, the opening price of it, that's where we buy there and see it. Now this is an impulsive. The objective is to mitigate this supply zone, and once it mitigates, then corrective move will start. Minor minor reaction, major reaction. Minor reaction is from a minor high, major reaction from a major high. Corrective move has started. That means we can no longer buy from the opening price of W. We can no longer buy from the opening price of the candle that is here, because objective is now complete and a new objective is in place to come and sweep liquidity of the low. I've explained this before. So candle QYR is what help price facilitate the objective to come and sweep the low. So candle C came up at the end of the reaction leg, a major reaction leg, and it's even a directional candle. Is opening price is what? High probability. Now what I want you to understand is this. Here, what did three candles have in common? Candle P, candle X, and candle C. What did they have in common? The candles will buy from their opening prices. Candle P, we buy from its opening price. Candle X, we buy from its opening price. Candle C, we buy from its opening price. What did they have in common? These three candles, P, X, and C. Candle P, candle X, and C. Before I talk, if you can get it, definitely you understand what I'm saying. Just reason for a while, reason for like 1 or 2 minutes. What did they have in common? Are you there? What they have in common is all of them, all the three of the candles, they came up at the end of a reaction leg. They came up at the end of a reaction leg. Like they turn bullish after the reaction have ended. Here there's a reaction, it ends, it came up. Here there's a minor reaction, it ends, it came up. Here there's a major reaction, it ends, it came up. Are we there? So any candle you wanted, any directional candle you want to buy from, if the previous candle is not opposite candle to it, it means there's no reaction there. It might not necessarily be visible on 4H. If it is not visible on 4H, go to 1 hour. If there is no opposite candle just before it, like 1, 2, 3, there is no reaction there. Reaction base makes it more high probability than when it does not have any reaction. Like, example here now, between candle X and W, the opening price of it, the reaction is not visible on 4H. Though this is schematic diagram, but I'm just showing you an example. So this one that has a reaction base, that is the candle before it is red, is more probability than this one that does not have any reaction with any opposite candle before it. The candle before it is candle X, and it's also a bullish candle. The chances of this one reacting to a institutional level is high. But now that this one has finished already and is coming at the end of the reaction, make it more probability than this one. I hope you understand this logic I've explained here. So as a result of the reactions, at the end of the reaction, any candle that form and is in line with the overall pro trend, it is high probability. And this pro trend we are talking about, you should not assume it's going to change character until it gets to the daily open. Either bullish or whether bearish is the same thing. Until it gets to the daily open, that is when you assume it is going to change character. we learn candle composition when we start. We learn candle composition when we start, right? So candle composition will help us. I told us then that it's going to help us in multi-time frame or top-down analysis. Multi-time frame analysis or top-down. Maybe we should even do a little of multi-time frame analysis. We will have the time. I believe this video is becoming very too long, but believe you me, if you really want to learn and you want to make consistent money profitably, like consistent profitability, you want to achieve that, you better be patient and learn. Be patient and go through all the details I shared here. If you do, then you do yourself good. So I think we should touch a bit of multi-time frame analysis so that you get to understand when a pro trend is likely going to turn bearish or it's going to turn bullish. When a pro trend, because as you are moving up now, you don't know when this overall leg will change character. We don't know when these strong lows, any one of it will become invalidated and change structure. So you should not only assume that it's going to turn to like here now. Maybe the reason why it changes here is because here is a weekly open. Let me go to the chart and explain. So that we can understand what I'm saying. But this is a Deriv Tradingview. There is no weekly time frame here, but there's a way you can actually mark your weekly candles. Let's mark open, high, low, close so that you understand what I'm saying. Candle composition, right? So this is V75 index. So we are in 4-hour time frame. First of all, let's go to daily time frame so that we can get our daily candles. Go to the daily time frame. I forgot to release something. I forgot to show you the bearish scenario. For that. So let's look at the bearish scenario. Of it will still be the same thing, just opposite. Alright. That means the reaction candles in the bearish scenario will be what? Bullish. Will be bullish. I forgot to relate to you the bearish scenario of the candle that will form after the reaction leg. So basically here we have, right, price move impulsively, created a reaction, then major and come back to sweep, right? So the reaction candles here are red, right? That signifies okay, they reacted to institutional supplies, then form a reaction and the bullish candle form. Now this is the whole basic idea behind this. When we're in an impulsive move, price move, a minor reaction form, then candle that the bullish candle that form at the end of a minor reaction, we enter from its opening price. We keep going, right? A major reaction form, it come back to sweep. A candle that form at a bullish candle that form at the end of the major reaction, we enter from the opening price. We continue bullish. Minor, enter any candle that form green after the end of the minor reaction, we enter from the opening price. We continue bullish. After the major, any candle that form, I hope you understand. So for the bearish scenario, it will be green candles that will form the reaction. That's what I want you to get clear. So here we are coming down, a minor reaction here. This will now be a what? A green candle forming the reaction to the signal demand, right? So any red candle that form after the reaction, we enter from its opening price, serving as resistance in this case to continue bearish, right? A major reaction form, it come back to sweep liquidity. Any red candle that form after that liquidity have been swept, we enter from its resistance, from its opening price, serving as resistance to continue with the pro. Now a minor reaction, a red candle that form after the reaction, we enter from its opening price, serving as resistance to continue pro bearish trend. Then major come back to sweep liquidity. Any candle that form after sweeping the liquidity that is bearish, we enter from its opening price to continue. I hope you understand that. That's what I want to call attention to. All right, now let's go to the daily time frame so that we do a bit of multi-time frame analysis and we look at what's it called, the summary. We summarize everything, look at some checklist, then we call it a day. All right, let's go to the daily time frame. I want us to do a little multi time frame analysis. Okay, good. All right, let's look at this. Oh, it's not looking messy. From the knowledge of composition we discussed earlier, let's look at how you can use that knowledge of candle, higher time frame candle composition to do top-down analysis and also multi-time frame analysis. Because when a pro leg is moving, you'll be wondering, okay, where is it going to reverse? The top-down analysis will help you, will guide you where likely those four legs that is moving either bullish or bearish will reverse. If it has not got into the weekly open or daily, in daily is going to serve as reaction, major reaction. But when it is weekly, that's when you now pause and wait for it to either break it or for it to reverse. So this is Deriv. Deriv does not have weekly what's it called time frame, but there's a way we can frame it out. Okay, this is daily time frame now. This is where we started this thing the other time. I said I wanted to confirm if it is daily support. If it's daily open, you can see I have marked daily open from here, so that's why it actually what's it called serve as support here. So daily open, you can see. So but we want to do a little of multi time frame analysis or top down analysis. Let's look at this place. Let's find one Sunday candle here, because this is daily candle. Today is this is Monday. This is Sunday. This is Sunday, right? Okay, this is Sunday. Let's count 7 candles back, because every weekly candle contain how many daily candles? 7 daily candles. Let's count it back. This is 1 2 3 4 5 6 7, exactly. Okay, this is 7. This is 7 day now. Is it also Sunday too? Okay, that is Sunday. Okay, for us to know the open and low of this candle, we started from the previous week, that is Sunday. Look at the opening price of that day candle. The opening price of that day candle is the opening price of the weekly candle, because that's the candle that started the new week. In this is the new week started from Sunday, not Monday. Started from Sunday, right? So this is Sunday, May 26th. Let's mark it. That's the opening price of the weekly candle. So what is telling us, it pushes up first. Open high. This is a bearish scenario. Open high, low, close. Where is the last candle? Okay, 1 2 3 4 5 6 7. Okay, here like this. And where is the opening? Where is the closing price? This is the closing price. How many 7 days? How many daily candles in weekly candle? Let's count. 1 2 3 4 5 6 7. Can we see it? Now let's mark the week. It means the week will be like this. This is the highest high it go to within this weekly window, and this is the lowest low it gets to. Okay, what I just did now, I have marked my weekly candle like this. I don't need to go to MT5 to go and find out where the opening price is. I've marked, that is exactly my weekly candle, and you can see that my weekly candle has 7 days what's it called daily candle inside, because this is daily time frame now. Let's mark the daily candles too. We want to do a deep multi-time top-down analysis and multi-time frame analysis. This is the first. Let's mark the opening price and the closing price of it. You can do this as well, even though on your phone you can do this already. Let's mark the opening price of these two, of that daily candle. Yeah, we want to know the opening price of our daily candles and the opening price of the weekly candle as well, right? Let's mark their bodies, because it's the body that will tell us the. If we didn't mark it from daily candle, when we go to 4 hour now, we won't see where it actually opened. But marking it in daily like this will give us a kind of guideline when we get to the 4 hour. And still, let's mark their open prices. The open price, okay, This is the opening price of the weekly candle. It opens here, it closes here, right? You see the body of the weekly candle. I hope you understand what I'm trying to. Oh, okay. Still, let me use it. Okay, this is the opening price of the weekly candle. Let's name it week 1 weekly candle, so that when we get to, be patient with me, I'm heading somewhere. You really need to understand this. You really need to understand this. Okay, the weekly, you don't want to type what's happening. Okay, let me just name it G. Let me give it G. That is the weekly open. That is the weekly open. Then others too. Let me that is the weekly open. Let me mark daily with what? Thin line. Thin line. Daily opens with thin line. Let me mark daily opens with thin line, so that we know where there is major reaction, where there is minor reaction, and where price want to reverse from. Let me mark all the daily opens with thin line. I hope you can see this. All these thin lines are daily open now. All these thin lines are daily open now. This one has been mitigated. Another daily open here, right? Then another daily open within that weekly candle. Another daily open here. Yeah, those just 1 2 3 4. Okay, this one has been mitigated. There is no need for us to mark it. The ones that have not been mitigated, that's the one I'm marking. Any other daily, okay, this one did not even show at all. So I have marked all the institutional levels that price can react to. This is daily time frame. Let's go back to 4 hour and see something. Good. All right, so now but we are back in 4 hour. How did those candles reacted to those levels, right? I said when a pro trend is moving, a 4H pro trend is moving, do not assume it's going to change direction until it get to the weekly open, right? Now at the same time, I said do not trade a candle that has already tapped on, what's it called, that mitigated daily weekly open or daily open. Why are you not going to trade a candle that tap on daily open? It's likely going to react because it is a strong reaction level. If it's a bullish trend, the previous prior action is a strong reaction level, because these are the places where major reaction will start. When price was moving here, we are using directional candles that price come back to, we buy. In this place, there is no any daily open here. Look at the first daily open we just marked now. Look at the daily candles we mark. How many 4-hour candles are inside it? Right? 6. 1 2 3 4 5 6. We can see it is 6 daily 4-hour candles inside one daily candle. The next one here, how many? 1 2 3 4 5 6. We did not draw their wicks. That's why you didn't see what's it called, that part. How many here? 1 2 3 4 5 6. So we have 6 4 ones inside of the daily candle, and the weekly candle itself, how many daily candles inside? 1 2 3 4 5 6 7. 7 days in a week. This is the weekly open. When price tap on the first daily open, what did price do? Did that candle hold? No. All the directional candles before then were holding, but the moment it tap on the daily open, it gave a minor reaction. That's where the minor reaction started. The moment it tap on daily open, of course these reactions too, they are visible. Probably these are in reactions to 4-hour candles here. They are open prices, but the one that is significant is the one you tap on the daily open. You can see that despite the fact that it is a directional candle, it did not hold. The opening price did not hold. I hope you can see here. Look at where my cursor is. This candle tap on daily open and it did not hold. So when a 4-hour candle tap on daily open, right, you have to mark your institutional levels. Expect a reaction. So do not trade its opening price by them. wait for the reaction leg to end, and that's why we wait here. And when the reaction leg end and give us a new instruction and directional candle, we now start our journey from there. Going up, the next daily open is here. When price tap on it, it come back, it reacted but still did not hold, and a major reaction started from there. Are we together? Are we together? And a major reaction started from there. A major reaction started from there. I hope you can see. I hope we can see. So a major reaction started there, and it continued to move down until it sweep the liquidity, because that's a major reaction. So the next daily open is here. Okay, this one price was actually able to flip it. It didn't show any significant sign of reaction here in this little. Probably maybe it has already been mitigated previously. Maybe price come back to it and tap. Yeah, we sell from it. It has been mitigated before. Yeah, you can see price come back to it and sell. But the ones the price did not come back to and sell, you can see that they react significantly. But this one price have come back to it and sell. The next one was the weekly open. So price actually shifted structure. If price did not shift structure, this weekly open supposed to have what? Hold price, because from our knowledge of what's it called, open high low close, our knowledge of open high low close, our expectation should be that when this weekly candle open here, open right high, that is the weekly open, it go back to the weekly open, the previous candle weekly open, it will find resistance level, then continue with the bearish trend, right? But here there's a change of structure, a change of character actually. So the only time you assume 4H is about to change character is when it gets to the weekly open, not the daily open. Daily open will be a major reaction only. This is top-down analysis we are doing now. I hope you understand this. So open high from the weekly open, because it is a bearish move, then we expect a pro bearish trend to continue. But in this case, there's a change of character, so that's why it only give a sign of reaction, or did not even reacted at all. Then, or it gives a sign of reaction, because even despite the fact that it pushes up, it still come back and react. All right, then price attack the next daily open, and definitely it give a reaction. It give you a reaction. It give you a reaction. All right, before it breaks, and as it breaks, then before we think of it changing structure now, I mean a change of character, is when we see the next weekly open up, before we can think of it changing structure again, is when we see the next weekly open. All right, let's form one weekly of, or let's look at this place. Maybe you can see one weekly candle, form another weekly candle, and see how open high low close also relate to top down analysis there, the same way we do it for this. Okay, we have to go back to the daily time frame. Let's go back to the daily time frame quickly. 1440. Okay, so we count 7 days candle from where we just stopped. 7 daily candles. All right, this is 1 2 3 4 5 6 7. This was the previous Sunday. We can see that was Sunday, May 26th. So 1 2 3 4 5 6 7. This is the last candle. The next Saturday, then this one will be included. This is the opening price of it, because it was Sunday like this. Yeah, so that's the body of that weekly candle. The lowest low it come to is here, so that's the week. This is the week. All right, it means the opening price was open, low, high, close. Look at the opening price here. This is the opening price. and see as we are going up, price come and test the opening price of it. Oh, I hope you can see it by yourself now, how it is sweet to do top-down analysis with your open, high, low, close. Price come and come back after reacting to this daily time frame, a daily opening price. It pushes price to find support from the weekly open. We're in the daily time frame now. It pushes price to find support from the weekly open. Let's go to 4H and see the candle that finds support there. This is 4-hour time frame now. We can see the candle that tag on our weekly open, the candle that we just drew, the weekly candle that we just drew. Look at open, low, high, it closes here, right? It closes there, it closes there. So that's the weekly candle, because on Deriv Tradingview, the highest time frame is daily, but we can use your knowledge of candle composition to actually come up with the weekly candle, because every weekly candle contains 7 daily candles. So we take it from Sunday to Saturday. From Sunday to Saturday. Sunday is the first day of the week in synthetic ETGs, not Monday, just like currencies. So the price, when it reacted to the daily open here, the one we marked previously, then it come back to the weekly open. So when 4H is moving as a pro leg, a pro trend, right? It's when it only gets to the weekly open, you can now have the be skeptical about whether it's going to reverse or it's going to only react, right? So in that scenario, whenever any forward candle tap on the weekly open, do not trade its opening price. Whenever a candle tap on the daily open, do not trade its opening price. Daily open, weekly open, daily open, weekly open. I hope you understand this. It's one of the checklists we're going to look into now. We're going to look you will write in your journal that whenever a candle, even though it's a directional candle, once it has tapped on the daily open or weekly open, do not trade this entry price. And look at what happened here. Despite the fact that it's only key state, so it is a zone actually. Look at the candle. Now that it has tapped on the daily open, the opening price, instead of it to continue with the bearish move, it invalidated, and once it has invalidated, it gave us a directional candle. It means the bullish move is ready to start. The bullish move has set in, and every other move there we keep on buying. I hope you understand how to do we just did a bit of multi-time frame analysis, right? We did a bit of multi-time frame analysis, but with the mere understanding of candle composition, with the knowledge of open, high, close, with regards to how candle move, right? You should be able to do multi-time frame analysis. When you sit down and think open, high, low, close, open, high, low, close, every candle is expected. If the trend is going to continue bullish or bearish, so they should respect their open prices until it gets to the weekly open or daily open. These are areas where we expect reaction to occur. Daily open, major reactions. 4H open, minor reactions. Weekly open, we expect reversal to continue with the pro weekly trend. If the pro weekly trend is bearish, it will continue with pro weekly trend. But if there's a change of character, of course, it's going to invalidate it, just like in this case. All right, so this is how to do multi-time frame analysis. I think this video should be over 2 hours now. Let me round up. Let me do a quick summary and round up. Well, the information I've shared here is enough to make you profitable, even though you're a total beginner. Once you just study this, believe you me, you will definitely become profitable, regardless of the market you are playing in. Regardless of the market you are playing in, regardless of the market, and you want to trade synthetic with me, of course you can see my WhatsApp number there. Just reach out to me on WhatsApp. If you need further clarifications, I'm ready to hold you by the hand or step of the way to guide you on how to fix your mindset, the psychological aspect, trading plan. Yes, trading plan is still there. I have a complete section on Telegram that talks about trading plan. Trading plan is also very, very important. Trading plan, these things are still there, so you can actually reach out to me on WhatsApp. I'll be ready to hold you by the hand. All right, trade management checklist. What are the things you're going to look out for before you enter? In summary, so you're going to write these things down in your journal before you enter. The first thing you have to do: narration. What phase is this price in? What is the current phase? After determining the phase, what is the objective of that phase? Find directional candle that is in line with that objective. Help price achieve this objective. Do not go against it. Even though you go against it, you are the one at the loss side though, because it's going to eat your SL. It's going to eat your stop loss. If you don't want to follow the objective, you will always be at the wrong side. Follow the objective and you'll be happy. Structure should be marked neatly to confirm the right bias, and after the right bias have been confirmed, find a directional candle that is in line, 4-hour candle that is in line with the objective. Enter in 15 minutes. I'll show you how to do all those things. That is the number one checklist. Is there a 4-hour directional candle that is in line with the objective of that current phase? If there is, follow. If there is not, do nothing. Also, is there a body displacement above it? Previous candle high, that is if I trend, but that is for bullish trend, and vice versa, that is for bearish. All those things I've discussed this. Does the candle have a reaction base? I've also discussed this about reaction to signal levels. The candle that has a reaction as basis, that is they have opposite candle before them, that shows a sign of reaction. That the candle that is a high probability, right? Has it already drawn liquidity? Has it already drawn liquidity? Yes. If it has already drawn liquidity, avoid it. Avoid that candle. Is the opening price of my forward directional candle having a V shape? Yes, I didn't discuss this. So if you go to M15, your directional candles where you want to enter from, they should have a V shape. Like most of the times, a V shape. If it's a bearish trend, it will be inverted V shape. Inverted V shape, yeah. I'm rushing this because you can see it on your screen. It's something you can read. It's something you can screenshot. It's something you can jot down. You get. Does the 4-hour directional candle mitigate my daily open or my weekly open? If it do, then avoid. I've just showed you just now why you should avoid it. If it is mitigated weekly open or daily open, weekly open there is chances of reversing. Daily open there is chances of major reaction, and major reaction will definitely not allow that 4-hour candle to hold from its opening price. I hope you understand what I'm saying. The timing price retracing to tag my 4H, that is the expansion windows, right? But even though it's not in this timing, it can still hold. If you are in line with the pro trend, it will still hold. If it is within this timing, good. More confluence, impulsive movement. So is the timing, the price coming to tag my 4H in line with the 4 expansion windows period? These are GMT 2:30 a.m. p.m., 9:30 a.m. p.m. GMT London time, and I said as a Nigerian we are adding 1 hour: 3:30 a.m., 3:30 p.m., 9:30 a.m., 9:30 p.m. If you're in other zone, figure it out. I've told you how to figure out. Now, after you have entered a trade, the number one watch list and the number one management, what is this called? I will call your attention to is how the candle closes. Tells you about the intention of price. When you have entered, how the candle closes tells you about the intention of price. So this is the management checklist, and let me say something here quickly. Okay, this is draw on liquidity and mitigation. Here, this structure A, if it is not a weekly open or a daily open, weekly open or daily open. If it is just previous low or previous high, I mean a minor structure in this regard. If it is a minor structure, when candle A mitigates it, you can trade. If A is a minor structure, if it is not a weekly open or daily open, when candle A mitigates it like this, because here candle A mitigates, it is not drawn liquidity. Candle B, it is the one that drawn liquidity. When candle A mitigates a minor structure, you can trade its opening price. If it is a minor structure, this minor structure is inside. You see inside. If it is a daily, the major structures, most major structures you see, they are actually reaction to daily open. So If it is a daily open, do not trade. If it is weekly open, do not trade. That is drawn liquidity. Candle B has drawn liquidity, you avoid it. If it is candle A, or if it is mitigate like this, trade it. Yeah. Now, after you've entered a trade, let's say candle A is a directional candle that form at the end of a reaction. How candle B closes tells a lot of story. If you have entered, right? If you have entered and in the next 4 hours after you have entered, candle B did not go to the direction of the pro trend where you want it to go. Let's assume it closes like this, close to your entry. It's telling you I'm not ready to go, and later I'll go to SL. So if it closes after 4 hours like this, let's say candle B open by 9 and it's expected to close by 1. If by 1 it's still closing close your entry, just exit, take whatever profit has given you, or else it will later go to SL. But if it closes far away from your entry, maybe like this, or probably in the direction where you want it to go, it means when the next candle open, definitely they will keep going to that very direction. So how this candle closes tells a lot of story. Is number one management what's it called, checklist you are going to look at after you have entered. Is it closing far away from your entry? If it's closing far away from your entry, there is hope. If it closes bullish, if it is a bullish scenario, leave it. You can even set your stop loss, go to sleep. The following candles will actually do what they need to do. Set your TP. But if it closes closer to your entry, it's telling you I'm not ready to go, just exit that trade. I hope you understand this management checklist I've explained, especially this last one, so that you are going to save yourself from Excel, right? So if it closes like this, it means when the next candle open, definitely they will obey and it will keep going. Yeah, I believe I've done justice to this video. Let's stop here. We have come to the end of this quick start module. Yeah, we have come to the end of this quick start module. All right. For you to get best out of this, right? You have to go through it over and over again several times. The more you watch and study, the more clarity you will get. The more you watch and study this, the more clarity you get. The more you watch and study this, the more clarity you will get. I'm repeating this, right? So watch, study, then go to your chart, mark opening prices, back test for test with your demo account for now. Do this consistently, and believe you will become good within a very short period of time if you diligently stick to this advice I'm giving you. All right, let me be plain as well and clear as much as possible. Trading as a whole is a mastery based profession. You need to master it before you can manifest here. You have to master before you can manifest, right? And in your mastery phase, you are not expected to focus on the end means of why you are mastering in the first place. Just focus on mastering and forget about manifestation at the initial stage. The more you focus on mastery and turns your back at manifestation, the faster the manifestation phase sets in naturally. You don't need to force it, right? It will set in naturally with ease. I hope you understand what I'm trying to call your attention to. You can't start to learn how to trade and be asking yourself, how much have I even made, when you are still in your learning phase. If you haven't become a professional yet, why are you asking, how much have I made, right? So if you focus on money at the beginning, you won't go far, you won't go anywhere, you'll fall out big time. Put in the work, then the money will take care of itself. Put in the work, master it diligently, the money will take care of itself. You don't need to force it. It will come naturally by itself when you begin to execute trades the right way, which is as a result of the mastery you have perfected. Are you with me? The big traders you see today, showing you lifestyle and all, do you think they just started yesterday and today they are big? Of course not. They have put in years of dedicated efforts in the past and you didn't see them by them. Today they have the result. So you should do the same so that someone can see you tomorrow and want to be like you. Somebody will see you tomorrow and wants to be like you too, right? Or do you think the doctors you see today, where they're pursuing their medicine careers in high school, 100 level, 200, down to their 500, their internship period, were they asking, since I'm learning to become a doctor, why am I not even paid salary? Why am I not earning? Or let's say an athlete that uses his whole youthful age to train how to be a professional athlete. Why is he not asking himself? Why is not earning while in training? So you see, you have to see trading this way. You have to see trading this way. You have to see trading this way because you can actually make it. If you focus on money at the beginning, you won't go far. You will fall out big time. You will fall out big time. You will fall out big time. I have to say this because a lot of people do not have the right guidance when they were introduced to trading. Their perspectives was, let me start trading so that I can earn money the way that guy on the online earn money. What they don't know, that guy has put in a lot of effort, mastered the craft before he arrived at that level, right? Before I arrived at, so you to have to put in a lot of work. I'm not saying, oh, you are not going to make money. This simplified approach I've given you, study it. Believe you me, you'll see result in a couple of weeks. But I have to say this as well. Put in the work, you will see result in a couple of weeks with this simplified approach. Or months, if you are truly committed. But at the same time, if trading alone, trading success does not depend on technicals alone. It also requires a mindset shift before you can become consistently profitable. It is 80% psychology and 20% technical knowledge. So if you have to fix your mindset, if you don't, oh, if you're an emotional type that can easily be moved by emotions, then you need to fix that to really become successful here. You have to transition from your old self to your new self. If you don't, manipulation will become very difficult, even when you have the old technical knowledge. Just like a traditional business, right? In the traditional business, before you can see significant growth, you also have to grow. Not in body growth, I mean mindset shift, personality, self-belief. You need to believe in yourself that yes, you can do this to actually make money. That's what I mean. If you're that in Thomas, don't expect money to pour on your table. Don't expect money to pour on your table. I've said enough. I strongly believe this clip, if studied diligently, will help you achieve that profitability you are looking for. Even as a total beginner, you can actually focus on this in a couple of weeks and you are going to see result if you have the right mindset. Believe you me. If you don't have a synthetic trading account yet, just click the drop down arrow. I've attached a link. You start with partner tracking, Deriv. Open your synthetic trading account today and set up your account. Open your account. And also, if you want to set up your trading view on Chrome, I also attach a link. After that sign up link, you're going to see another link where you can set up your trading view as well. It's also attached there. Lastly, if you want to reach out to me for more clarifications, further clarifications, you see my WhatsApp number at the bottom left hand side of your screen. You can reach out to me on WhatsApp. Feel free to reach out to me on WhatsApp. I'll be ready to hold you by the hand all step of the way, guide you on how to actually become consistently profitable. Believe you me, I will be willing to guide you. And if you want to join my WhatsApp group, I have a very huge community on WhatsApp. You can also reach out to me. I will send you the link. Look at my WhatsApp number here. Check your screen. I will also send you the link to join my WhatsApp group. Yeah, it's 100% free. It's 100% free. Yeah, do enjoy the rest of your day. Watch and study as many times as possible. Bye for now.